Today, we have a very special guest joining us, José Mayora. We talk about the 7 most common investing mistakes people make, especially in today's economy. José is the author of Wall Street's Blind Spots and the co-founder of the Divita Value-Growth Fund, where he serves as senior portfolio manager, overseeing a $25 million global equity fund. José is a CFA and holds degrees in business and economics from the University of Virginia, as well as a master's in economics from the University of Rey Juan Carlos in Madrid. I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In our conversation, José breaks down some of the most common investing mistakes, like assuming a great company automatically makes a great investment, ignoring valuation, and letting media noise shape your decisions. Plus, José explains why focusing on cash flow, not just earnings, is essential for smarter investing. This episode is full of practical insight for long-term dividend and value investors. Let's get started. José, welcome to the Simply Investing Dividend Podcast.
Thank you for having me here, Kanwal.
We're so happy to have you on today. You've got a lot of experience. You've written a book, a lot of experience as an investor. You also run your own hedge fund as well. So we've got a lot to talk about today. We're going to talk about, what's happening in the markets are very high. Today, as we're recording, the markets are down. But normally we've seen in the last couple of months, the markets keep going up, up, and up. And so we're going to look at what are some of the common investing mistakes that investors make? And we're so happy to have you here because you can help guide us and give us some of your experience and knowledge and wisdom.
Well, thanks again for having me here. It's a pleasure, and I can only hope to, enlighten your audience with anything I can.
Okay, awesome. So before we get started, can you tell our audience a little bit about yourself and why you decided to write your book?
Sure, absolutely. So I'm a Guatemalan native, so I was born and raised here. But after high school, I went to study finance and economics and in the States, and I pretty much stayed there working in investment banking. While I was working, I did the CFA. Then I went to Europe to get a master's in economics. So I've been pretty much from an educational standpoint and a career standpoint in finance and econ throughout all my life. But it's funny because at every corner, ever since I started, I kind of didn't like what I was being taught. I always kind of had like a contrarian view. So like even though in the CFA and in college, I was taught the modern portfolio theory and things of that nature, I kind of didn't swallow that pill directly. I instead went kind of into the rabbit hole of value investing. And similar to economics, I did economics as well, double major in college, and then in my master's, I kind of didn't like the school of thought of Keynesian economics, but instead I kind of like the Austrian school of thought, which is a little bit more marginal, kind of like how value investing is a little bit more marginal, even though, in my opinion, it's the best way to invest. But anyway, not to keep the story too long, I always had my dream because of kind of those hidden passions of mine to do a public equities hedge fund with a value investing approach. And for reasons I won't bore you with, I was very lucky enough to partner with somebody here who runs a family office in Guatemala, and we decided to launch a fund about 3.5 years ago, almost at this point, again with a value investing approach. But there's several challenges of having a fund in anywhere in the world, but particularly in Central America and Guatemala. And part of it is that there's no culture for investing in public markets. People kind of see public markets more like a casino. And I know that's kind of true everywhere in the world, but it's probably more so here because we don't have access to 401ks where we invest in publicly traded companies. So it's something very foreign to most people. And the people who do kind of play into the market don't necessarily do it with a lot of their money. It's more kind of like the casino money, the playing money for learning and understanding a little bit about the markets and what's going around in the world. And so part of the reason for the book is to try to garner trust from people that not only investing in the market is a great way to compound wealth over time, but doing so by either learning what I teach in the book or giving, entrusting the money to us, it's a great idea, right? And we were talking before we were recording that gaining that trust is difficult because the markets obviously don't go up in a straight line. And so I wanted to give people, a very good framework of how we think, so that in rough times, when they come, because they eventually always come in a temporary nature, that they entrusted their money with people who know what they're doing, and that those rough times will pass sooner rather than later. And so it's kind of part of this educational effort that I wanted for both my existing and potential investors. And so that's the main reason for the book.
Yeah, no, and I agree with you. I think even in North America, right, even in the US and Canada, we find, if you tell people you invest in the stock market, a lot of people are going to think, well, why are you gambling your money? They think it's like you said, like a casino, and it's just a place to gamble your money away. And you and I know, and a lot of our guests we've had in the past know, that it's not. If you know what you're doing and your research is done and you do it methodically, and you're not just guessing, then it's not gambling at all. And even, you mentioned you're in Central America, you're based in Guatemala. I think your message is universal. It's important for everyone to hear this message. And we're going to cover that today, right? That's what we're going to look at, the 7 common investing mistakes. So let's get into the first one. And I've got the list here. Here's number 1. Believing that a great company automatically makes a great investment.
That's actually one of my favorite ones, because I think it's the trap that most people very easily fall into. And the idea is that, people see a company that's doing great things. And obviously the media noise doesn't necessarily help, because when a company is doing something good, they hear about positive things about it all over the place. It's conversation, social gatherings, and things of that nature. And so they think, because I kind of understand this company, I kind of listen to 1 or 2 podcasts from the CEO, I like his vision, and the products are great, that automatically makes it a great investment. But the reality is that everything's further from that truth. It's so important to understand what price you're paying for that great company. Because even the best of companies, if you're paying too high a price, then essentially you are paying a price that may be higher than the expectations that need to happen from the underlying cash flows and dividends and returns for you to actually be able to make a decent return, right? So it's all about what expectations are embedded into a price. If the expectations are relatively low relative to what you think the company is going to achieve, then it may be undervalued, and then it may be a good opportunity. But not just because a company has quality that automatically makes it a great investment, right? And so I like to highlight that, because again, I think it's the most common mistake, and I can't tell you how much friends in weddings or just in any social gatherings, they come and say, look, have you looked at this stock? And they start talking about the business merits, and they automatically think that makes it a great investment. And I'm thinking to myself, because obviously I'm not going to start giving a lecture there, but I'm thinking to myself, you've only told me why you think the company is great. You haven't told me why you think the price is justified. And those things are 2 very different things, right? And so super important to keep that in mind.
Yeah, absolutely. I mean, I think what we're talking about is there's no point in buying a stock or a company when the price is overvalued, when it's already overvalued. It's very high, right?
Absolutely.
I think I'm probably not going to get the quote right. Somebody said this. Maybe it was Warren Buffett, or maybe it was another dividend investor. Somebody said that the profit is determined the day you buy the stock, right?
Absolutely.
That's what's
Absolutely.
going to be
you make your money in the buying, because if you buy at the right price, sooner or later you should do, at least on average, decently well, right? But the opposite, of course, it's true. And part of the reason why this is a common mistake is because people are so used to looking at stocks as buying low and then eventually selling. And they miss the reality that stock is actually linked to a business. That business produces cash flow, and those cash flows, directly or indirectly, are going to be your sources of return in the long term, right? So any hype that happens temporarily may boost the stock price for a moment, or temporarily, but in the long term, if the cash flows that needed to materialize and the growth that needed to materialize to justify a specific valuation, if those don't come, then you're going to be pretty much toast, because the market's going to reset and say like, oh, we thought there were going to be $10 billion in cash flows 10 years from now, or at least that's what the valuation implied, even though people don't kind of understand that. And 2 or 3 or 4 years down the line, when something happens and there's a catalyst and they realize, oh, wait, this company is going to get stuck producing $1 billion in cash flows and not 10. So even though it was a great company, you end up losing money, right? And you can see that with various different stocks in the dot-com bubble. If you look at Microsoft, I mean, right now it's doing pretty well, but Microsoft crashed for about, I don't know if it was like 40, 50, or even 60 or 70% when the dot-com bubble burst. And it's not because they stopped increasing their bottom or top line and their cash flows. It's more because the expectations that needed to happen, or the growth that the cash flows needed to have in order to justify the previous peak valuations, were so high that even though the company was still growing at a decent clip of 8, 10, or 12% yearly, it wasn't enough to justify paying whatever the valuation was at the moment.
Yeah, absolutely. And it's so important not to fall in love with the company. You should look at the fundamentals and see if it makes sense, right?
Absolutely. And what you're saying is very important. If I may take a parenthesis here, is that when you fall in love with the company, you might be kind of very biased, and you start getting into the psychology of the market, where you're just looking for information that confirms your belief. And so it can get pretty dangerous, right? And that's why I always try to be impartial. And in fact, I don't like investing in companies that originally came from somebody else's idea and investment thesis, because then I think, was I tainted too much for me to actually go and criticize it? So I like to find companies by myself, do the work, do the analysis, give my opinion, and then out of humility, which is important to have, you go and see what other people are saying to see if you miss something, or if and kind of contrast with your opinion. But after you've done the work, so that you're not biased, right? And that's, I think, super important.
Yep, absolutely. And so we talked about valuation, so that brings us to number 2, right? So the other common investing mistake here, number 2, is ignoring valuation and paying any price, even for a quality company. So what's wrong with that?
Yeah, absolutely. And it's very linked to the first mistake we talked about, but it places even more emphasis on the issue of price. Right, and maybe it helps to kind of look at an example. So if we look at Tesla today, I don't know exactly where it ended this particular day, but it's over $1 trillion in valuation, right? So if you pay $1 trillion in valuation for Tesla right now, the yield that you're getting from the cash flows it produces, I think it's maybe around 8 billion or 10 billion, but let's say it's 10 billion. That means that you're getting 1% in cash flows today relative to that $1 trillion valuation. Again, I'm using rough numbers here. So if you're depending on the company's cash flows in the long term for your return, then that means that those cash flows need to be at least 7, 8, or 10 times more than they are today to get you to a roughly maybe 7, 8, 10% yield, cash flow yield relative to today's price in the future. But the reality is that you probably need even more than 10, 12, than the 7, 8, or 10 times of today's cash flows. You probably need more like 13, 15, or 18 because of the time value of money, right? If those cash flows eventually materialize and grow a lot, okay, great, but you'll have them 7 years from now or 10 years from now, and not today. And the problem with not having those cash flows today is that you're delaying compounding. If you have a dividend-paying stock right now that pays you maybe 7% yield or 6% yield or whatever it is, it doesn't need to grow for you to already have that yield. And every time you get that dividend paid to you, you can reinvest it, and compounding starts working its magic. If you buy Tesla, then how are you going to start compounding when your yield is 1%? Even if you reinvest that, or the company reinvests that on your behalf, because it's not a dividend-paying company, even if the company does that, it'll take a significant amount of time and significant amount of returns on invested capital for actually that to bear fruit. So it's super important to keep in mind that the price that you pay has to always be referenced in relation to the cash flows that they produce now and in the future, considering the opportunity cost of delayed compounding.
Yeah, that is so important because it's, again, related to what we were talking about before. It's so easy for somebody to fall in love with a company and ignore the valuations, just like you said. What makes it challenging is, I think, social media and the internet, right? Because now you've got everybody who's telling you that the price is going to keep going up and it's going to go up even higher. And that leads us to number 3, which is letting the media, and I'm going to say social media, or I guess any media, even could be traditional media, letting the media noise, good or bad, shape your decisions.
No, absolutely. And I think the issue here is that the markets are very psychological. And I think people really need to understand that. And what I mean by psychological is that they're driven by either FOMO or fear. And that's when prices can diverge materially from what they're actually worth. So right now, for example, we're in an era where the market as a whole has done pretty well. The Magnificent Seven stocks have done pretty well. Nvidia has, succeeded any expectation that anybody could have ever had. And the AI kind of trade has been playing well, right? So the psychology right now is you see all these media and social media commentary around the future and the reshaping of industries and all of these things. And the immediate reaction from people can easily be, to have FOMO and say, okay, my friend did this return just by playing the market and doing this and this and that. And even if you're a professional investor and you think they're overvalued, you're getting your clients and saying, yo, why didn't you invest in these Magnificent Seven companies? Because in hindsight, everything seems very easy, right? And very simple. So you get your clients or your investors and they're saying, why didn't you do this? And so you start getting maybe not FOMO directly, but FOMO from your investors, right? And so that plays into decisions a lot. And what you have to try to do is kind of stay away from that noise. Think very clearly, think very long term, and focus on what are the expectations that the price currently has, or what expectations are embedded in the price in terms of what growth needs to happen, what needs to happen to margins and things of that nature, for you to get an adequate return. Do your qualitative research and think, okay, is it highly likely that those targets are going to be met or not? So to give you an idea, right now, I think like Nvidia is maybe like 50 or 60 times price to earnings ratio. I'm not sure where it is. And I won't get into the math here or anything, and I explained this a lot in the book actually, but that probably means that Nvidia, and I don't know the exact number, but it's something ridiculous like this, that Nvidia needs to grow its cash flows by maybe 20 or 30% probably for the next 10 years, right? In order for you as a buy and hold investor to get an adequate return depending on those cash flows, not if you sell it maybe before it bursts or whatever it is. And so your job is to think, okay, not what the media is saying, but is this likely to happen, right? And when you're talking about compounding at 30% growth rates for 10 years, that's maybe like, having cash flows 5 or 10 times bigger or more, 15 times bigger than they are today. And so you kind of have to put things into perspective and say, I don't care about the media, I don't care about the noise, don't worry about FOMO, don't worry about fear, what's realistic, right? And that's when you kind of start making your analysis in that way.
Yeah, that is so important. And I think one of the lessons for me personally is to ignore a lot of the noise out there. There's so much noise out there. We talked about social media. It just compounds it. So I don't know if you agree. My philosophy is just to ignore the noise and make your own research and make your own decisions.
Totally, absolutely. I mean, it's, I think, the best advice anybody can follow, because it's really easy, even for us professionals, it's really easy if you let yourself kind of go into that world to kind of start second guessing your rationality, because markets at times can be very irrational, and so kind of seeing that noise or following that noise can be dangerous. And the other thing is that media is made to drive clicks. right? They're made to drive viewership, and there's so much content out there nowadays that the headlines have to be very kind of like grabby, right? And so they start implying things that may or may not be true, that can kind of exacerbate that FOMO or fear. I always laugh at the headlines like, Jeff Bezos just lost $25 billion in one day after earnings, or Jeff Bezos or Elon Musk or whatever made $50 billion after this, right? And that really doesn't have any meat to it from so many different respects, as obviously but they put it, and the media knows it, but they say it because it drives clicks, right? So following the media, especially if you kind of follow the headlines more than anything, because if maybe you dig into articles, then it maybe can help, but if you follow the headlines, you're just going to get lost into the FOMO and the fear very easily.
Yeah, absolutely. I think people have to understand that the media companies are corporations, and the purpose of a corporation is to make money and to be profitable. Their job is not to make sure that you are a successful and confident investor. Their job is to make money. And like you said, they're going to make money off of advertising. They're going to make money off of you clicking on their articles and sharing the articles or commenting on them, because that's what's going to drive traffic, right?
Absolutely, 100%.
So let's move on to number 4, which is this one's a favorite of mine, because it says here, number 4, trying to time short-term stock moves instead of thinking long-term. So why should people think long-term?
The reason is simple. It's thinking long-term is a lot easier to determine something to be true or not true generally over the long term than it is to predict what's going to happen in the short term. In the long term, there might be 4 or 5 important variables that are going to determine whether a company is going to do well or not. And you can focus on those 5 variables, like competitive advantages, industry dynamics, risks that are embedded within a particular industry or company, and you can focus on those things. Versus when you're thinking about the short term, there's so many variables that are going to affect whether the stock's going to go up or down 2 or 3 or 8 months from now, or even 2 years from now, that it's simply impossible to be able to make good decisions, right? And so you got what's going to happen to interest rates, what's going to happen to geopolitics, what's going to happen to all the wars that are out there, are they going to finish or not, what's going to happen to commodity prices, what's going to happen to inflation, what's going to happen with so many different aspects that may not even have to do anything related to a particular company, but yet in the short term, they can influence that company's stock price, right? So you have to know that when you're trying to make short-term decisions, buying and selling, you are setting yourself up to a much more difficult task. So I think it was Warren Buffett who once said, it's fairly easy to determine where Coca-Cola is going to be generally 10 years from now. I mean, obviously not specifically what the cash flows are going to be 100%, but generally is it going to look better or worse? It's fairly easy. But it's very hard to predict what's going to happen with Coca-Cola's stock price in a month, right? And the other thing that's really important is that when you're long-term, you're focused on making relatively few high-quality decisions. And that maximizes your chances of making good decisions. When you're doing short-termism, buying and selling, following the noise, you're doing so many more decisions with a lot less focus and criteria that the chances of making many more mistakes are high, right? And so there's a lot of things into it, but focusing long term, I think, is extremely important. Oh, and that, again, there's so many reasons, but another important one that I almost forgot, and it's super important, is that time is your friend. When you're letting things compound and you're being patient, you have everything to win. Because when you get dividends, or the companies give cash flows, and whether you reinvest those dividends or the companies reinvest those cash flows on your behalf, there's a compounding process there. That it may feel slow in our day-to-day lives, but after 10 or 15 years, it can really make magic, let alone 60 years, right? That's how Warren Buffett came to have Berkshire Hathaway $1 trillion valuation, right? And so you are making essentially compounding and time your friend. If you're a short-term trader or investor, it's almost kind of like the opposite. Time doesn't help you at all. It doesn't matter. And so it's super important to understand that opportunity cost, and that's why kind of Charlie Munger, and I can't remember the quote exactly how it is, but he said the best thing to do is just find a great company and sit on your ass, because you simply just don't want to interrupt the compounding process, is what he used to say.
Yeah. I like what you said there. Having a long-term perspective, there's only a certain amount of things you need to focus on, right? It's just the fundamentals, and it's like you said, it's easier to predict. I mean, we can't accurately predict where things are going to go, but I like your example of Coca-Cola, right? We know next 10, 20 years from now where it's going to be. And you can see that when you look at the stock market graphs, right? If you look at the graph for like 1 day or 1 week, it kind of goes up and down, and stock prices go up and down all the time. But you look at an 80-year, 70-year graph of like the Dow Jones, and it just does this.
Exactly, and that's a great parallel. In fact, the best parallel. And I'm going to steal that from you because it's exactly that. Like, it can be counterintuitive to think, how can thinking long term be easier than thinking short term? Because typically longer term horizon, there's more things that can go wrong. So you're saying, no, how can you predict that? But in fact, when you're talking about companies and or the stock market in general, it's like, it's really easy to know that unless there's some tail risk out there that we're doomed anyway if it happens, the S&P 500 is going to be higher 15 years from now than it is today. That's almost certainty, right? And you don't need to be a magician to predict that. But again, if you take it to the other extreme and you say, what's going to happen to the S&P 500 a month from now, I guarantee you very few people are going to really know. And if they hit the mark, it was probably luck.
Yeah, absolutely. Yeah, I agree. All right, let's take a look at common investing mistake number 5. And that number 5 says projecting recent performance too far into the future.
Absolutely, and I guess I really like all of these mistakes, and I keep saying this is a very important one, but they're all very important ones. But I like this one a lot too because it's very intuitive and very common, and I like to almost call it in a way kind of the mistake that leads you to what I call the Zoom path, and I call it the Zoom path, and I put it in the book like that because it's almost what happened, not almost, it's what happened to the company Zoom, right? The one we used to communicate in COVID and many people still use. It was, the growth during COVID and also pre-COVID was, amazing. More than 100% annual increases year over year. And they had like maybe a 5-year trajectory with that growth. And so people got really excited. They thought that teleworking was going to be the thing of the future, et cetera, et cetera. And so people were really willing to pay a significant price and a premium relative to what it produced, thinking that growth was going to continue forever, right? But it's a very dangerous game to extrapolate the recent past into the future, because what happens is when companies are successful and they're having significant growth, it's only a matter of time that invites competition. And in the case of Zoom, you had Microsoft Teams, you have the platform that we're using now in a niche way, but then you also have Google Meets and all these things. And it wasn't necessarily something unknown. A lot of people still use Microsoft Teams back in the pandemic. Zoom was the most popular one, but people knew about it. And so you have to be careful of thinking that good years can extend themselves forever. Eventually somebody's going to try to compete you, and if you're going to pay a price thinking that growth is going to continue forever, you must be or not forever, because that would never happen, but at least for 10, 15, or 20 years, you must be very sure you understand what are the competitive advantages that it has, or a particular company has, that will stop those competitors from taking market share or maybe preventing some of that growth that you've enjoyed in the past.
Yeah, and a perfect example, I'm old enough to remember 1999 and 2000, the tech bubble. And so we had technology companies that were doubling in price, and they would double again, and they would double again in a short amount of time. And people would look at that and think, well, this is going to go on forever.
No, absolutely. And it's crazy. And it's crazy because, even if you just study history very briefly, I mean, you don't have to become an expert. It's very clear that it's very hard to sustain a high growth rates, and typically businesses that grow significantly over time, it's more because they had decent growth rates for a long period of time, and therefore compounded, than because they were able to grow in 10 years at 100% rate, right? So that's why you also, again, have to think long term and say, what are the competitive advantages of the business that would allow it to maybe not grow at a 50% clip every year, but as long as it grows maybe 10, 15, or whatever the case may be at a given price, as long as it grows for 20 or 30 years, compounding is going to be your friend, right? So it's important. And the other thing is that this extrapolation goes both ways. In fact, value investors kind of take advantage of the extrapolation of the recent past to the future, because a lot of times when a company is not necessarily doing well, many times it's due to temporary factors, but the investor's typical reaction is to say, I don't want to be with all this noise, and so I'm out. And they're selling, and they're short selling, and that suppresses a company's stock price. But the recent past is not necessarily a determinant of the future, right? And in those opportunities, if you think things can change, and there may be very good reasons and actually easily identifiable at times that they're going to change, well, it can present a very good opportunity because the market's making that mistake as a whole of extrapolating the past to the future.
Yep, absolutely. There was, I'm going to get the date wrong. I think it was with TC Energy, Canadian energy company. I believe it was in 99 or in 2000, somewhere there, they had cut the dividend. And so if you were just looking short term, you would say, well, this is a bad company, I'm not going to buy it. They just cut their dividend. But from that point on, they increased the dividend for more than 25 years consecutively after that cut. Yeah. So,
and that's a great example because, especially with dividend stocks, like, and in part for good reason, but the market hates when a company cuts dividend, even though it may actually be a good decision, because sometimes, not always, sometimes it's because bad decisions, but sometimes cutting a dividend is because they need the cash to invest in something that has actually a very high reinvestment opportunity. Or maybe sometimes they cut the dividend because the price is so low that they want to do repurchases, right? And so, but the market is like, cut the dividend, maybe there's some issues that are around the corner that they don't like, and they extrapolate that kind of recent trend to the future. And that's a perfect example of how it doesn't always happen that way.
Yeah. Okay, so let's move on to number 6. Common investing mistake number 6. Selling too early and cutting compounding too short.
Perfect. And this it's kind of related to what we were talking about before in terms of short-termism and kind of the negative impact of the opportunity cost of not having things compound. And it's very, very tempting in the market to find a great company. Maybe its price increases 30, 40, 60%, whatever the number is. And it's very tempting to feel like, it used to look like it was a great price 6 months ago, but now, I mean, it's still okay, but it's not necessarily as juicy as it used to be. So I'm going to take my gain and look for something else. And in some occasions, that's actually like the good decision. But a lot of times, if you actually have a great compounder, a company that is consistently reinvesting capital at high rates or paying you a very good dividend that you can then use to reinvest, you're going to let, again, compounding and time be your friend. And a perfect example here, if we think about even a dividend company, is like a lot of people think that Warren Buffett not selling Coca-Cola around the year 2000 when it kind of peaked. It's been up and down, but that's where it's kind of rise in stock performance peaked, and then it was like stable to down for over like 10 or 20 years, and it's almost still similar to that price and not much higher than it was then. A lot of people think it was a mistake because the stock price didn't go up. From my perspective, however, and I think that's how Warren Buffett sees this, is I am getting my dividends that just 1 year, with every 3 years of the dividends that I get, I'm getting my money back from my original investment. and it's helping me continue the compounding. Because I get the dividend, I've invested in something else, and that something else may have a high return on invested capital. So it's very important to just understand that it's not about the stock price in the near future, it's about how are you going to make compounding your friend. If for whatever reason the stock price went up 50 or 100% and you think that company is going to stop helping you compound, then sure, you can sell it and move somewhere else. But if you think that the company is still a great company and it's going to help you compound, whether via dividends or reinvesting its cash flow into the business, it's typically a mistake to sell. And in fact, I think I hear some of my investors always tell me, like, you can never go wrong with taking profits. And I say, that's true, but it's also true that nobody ever did a 10x or a 100x by selling early, right? And the great investors that have compounded at north of 15% over time, it's because they had maybe 3 companies that did 10 or 20 or 30x in a 10 to 20 year period, right? And so maybe they did bad decisions not selling some of the gains in the other stocks, but they were more than outweighed by the 2 or 3 companies that 10 or 20 or 30x. And it's very difficult to know in advance which of your 10 or 20 portfolio companies are going to 10x or 20x and which ones are not. So if you start thinking, I'm going to sell because it doesn't look great for compounding, you're going to miss out on those 2 or 3 selling early, and that's going to be a much higher mistake.
And I love the example of Coca-Cola that you gave with Warren Buffett. I think he still owns the company, correct? I think he still owns it, yeah.
After 35 years, he still owns it.
That's unbelievable. That's incredible. All right, let's move on to our last and final number 7 common investing mistake: focusing on profits instead of real cash flow.
Yeah, and this may be a little bit more technical. And the beauty for your audience, I think, is that because you guys think in dividend terms, this issue is not as important as for non-dividend paying companies. Because the dividend is actually real cash flow that you're getting, and if you're really obsessing over it, then kind of any accounting, let's call them shenanigans, are not necessarily going to affect you that much, and you're going to see that. But the problem with accounting is that accounting profits are made to inform investors and say anything to investors that's material. And that sometimes means that your profit doesn't necessarily equal cash flow. And at the end of the day, where does your source of return comes from? Cash flow. So if you have, like, for example, a one-time loss for a bad acquisition decision that prior management did, and you're taking an impairment loss right now, that's a non-cash loss right now. And if you think management is going to do the same mistake, then that loss is important because it means that cash was deployed poorly in the past. And so cash may be deployed poorly in the future. So definitely important. And as an accounting, from an accounting perspective, you want to convey that. However, if you think that's from the past, and this new management won't make that mistake, as an example, right? Because there could be many reasons why you think that it won't affect the future. Then you want to not take that into account and say, okay, what does a company's cash flow producing abilities look like in the future? Not taking this into account, right? And that's just one example, and it's the easiest one to talk about real quickly, and that's why I use it. But it comes from many points of view. Like if you think about depreciation is important, and in some cases it does convey cash outflows, and so you need to take it into account. But in some cases, depreciation is not doing its perfect job in conveying the cash outflow needs of the company from a CapEx standpoint, for example. And so you have to think very carefully and look at accounting profits, start from there, and then say, okay, what is actually recurring from this accounting profit? What isn't? And focus on the cash flow producing ability that is relatively recurring in the future.
Yeah, no, that's a great answer, and all of the answers were fantastic. These are, there's 7 common investing mistakes. I'm sure there's other things that investors can run into, but that's really good advice there. So, Jose, you talked in the beginning about value investing, right? Mm-hmm. I'm curious, what got you interested in value investing? Because when you say value investing, I think of Benjamin Graham right away.
Yeah.
So what got you interested in value investing?
Well, I think there's many reasons, and it's hard to pinpoint like how it happened, because I've been a value investor at heart for so long, almost 20 years, that I really at this point don't know what got me into it. But I have realized that value investors all have a very similar personality in many regards. And so when we find this kind of strategy that aligns with our personality, it just kind of hooks us. And the opposite is true. Even if you think value investing is the best way to invest, if you don't have the personality, it doesn't hook you. So it's almost like almost in your blood in a way, right? But I think that there's maybe 2 or 3 things that attracted me to it. One is the fact that there's so many examples of investors that have outperformed the market for decades, regardless of economic conditions and the context of the moment, for decades using this strategy. And Warren Buffett being the best example of that. So kind of early on, I'm like, oh, well, this is the best investor of all times. What does he do? And so it got me really interested. And then as I started thinking about the philosophy itself, it really clicked with my personality of kind of being patient, being very rational, not liking to follow the herd or the crowd, having kind of like a contrarian personality, being very curious to learn about so many different aspects. And so it kind of just evolved naturally over time. And the more I learned about value investing, the more I put it into practice, the more I realized its power. And essentially, if I could summarize it in 1 minute, it's that with value investing, you kind of break the risk-reward paradigm that we're all subject to in finance. So typically, if you want a higher reward, you need to subject yourself to higher risk. But when you're buying companies with a wide margin of safety that are undervalued, you kind of have a very low probability of loss in the long term. In the short term, volatility can do whatever. But in the long term, you have a very low probability of loss. And yet, precisely because you're buying undervalued, you have a very high probability of gain in the future. And so you're kind of, again, breaking that risk-reward paradigm. Very low risk, very high reward. And so I kind of fell in love with that. And that's kind of how I ended up with value investing.
Oh, that is so good to hear, because I think we're on the same page. I have the same mentality of investing, thinking long-term, having a margin of safety. I've been doing this for over 25 years. I call myself a dividend value investor. Anybody asks me what my investing style is, it's dividend value investing. So I think we're on the same page. I cover all of that I have a Simply Investing course where we teach people about dividend value investing. So a lot of the concepts we talked about today are the same, right? Whether you're investing in dividend stocks or not, right? If you're a value investor, that's what you're going to follow.
Absolutely. And in fact, if I may just interrupt for 1 second, in fact, as we were talking before we started the recording, many of my stocks in my portfolio are dividend-paying companies, right? Because you can definitely apply value investing within the dividend investing kind of realm. And in fact, if you focus on dividends, I think it's a natural progression to kind of evolve as a value investor, because again, when you're focusing on dividends, you're focusing on cash flow. And so it kind of rationally, you start evolving to understand more about what really matters than thinking about the price going up and price appreciation, which is where it's most easily or it's easier to fall into the traps we just talked about.
Yep, absolutely. So Jose, you've spent a lot of time, a lot of research in writing your book, and we can see the cover there. It's Wall Street's Blind Spots. Right?
Correct. Yeah.
And okay, I want to make sure I get this right. So the book is called Wall Street's Blind Spots: A Unique Perspective on Value Investing, Valuation, and Capital Allocation. So what are you hoping that your readers are going to get out of that book?
Well, many things, and among which are a way to understand the importance of what we just talked about today. But I think the most important thing is that it's actually a very practical book. I do provide a framework to help people understand what we're talking about initially and kind of talked about throughout our conversation is how do you know what are the expectations embedded into a company's price? Because once you know that, then your research is, okay, are those expectations likely going to be met or not? And it's a framework that gives you kind of like a guiding North Star that is very practical yet very real. And it's very long-term focused, very long-term oriented. And in fact, the book is called Wall Street's Blind Spots, because there's a core theme in the book that I didn't get into our conversation because it's a little bit more technical, but I do distill it in a very friendly way. But there's one very important thing that I think most people, even sophisticated investors, I'm sure you're not one of them, but many sophisticated investors fall into this particular trap. And I kind of say why falling into that trap is the worst mistake you can make. And again, it's more about valuation, present value analysis, blah, blah, blah. But it helps people understand that and yet give a very practical framework that you can apply in real life.
Okay, that is great. I think we need more of that. We need more people delivering that message that you're talking about. And it is education. You're educating other investors on, giving them guidance so that they can make better decisions, right?
Absolutely.
So as of this recording, it's the middle of November. The markets have been going up, and up. Today, we saw big declines. Almost 1.9% drop in the S&P 500 today, and the markets are down again. So, and then plus we have tariffs. There's tariff trade wars going on now all over the world.
A lot of noise.
So a lot of people are fearful and scared of investing, right? Especially in the stock market. So I know this is a big question, but what are one or two things that we could leave the audience with? What would you any kind of guidance or any kind of wisdom that you would want to give to our audience today, given the climate that we're in right now?
Absolutely, and it is a great question, obviously a very timely question. And what I would say is maybe one or two things. It's always good to be invested in the market. If you have a long-term horizon, like if you're retired and you depend on your income, if you do a dividend type portfolio, you can be okay, but you have to be more careful if you have a short-term horizon than a long-term horizon. But it's always good to be invested in the market because then you don't interrupt the compounding process. And it's not good to time it for reasons we kind of discussed today. But it's also important to understand where you kind of stand in history, right? And the market right now is somewhat hypey. I mean, some would argue, including myself, very hypey. But at the very least, not undervalued. That's for sure. And so that just means you have to be very careful with these mistakes we talked about today, and that you have to be very selective. If you play in the dividend space, you're probably more defensive and in a better position than trying to kind of follow the hype. And the non-cash, non-dividend paying companies. So you definitely have to be aware of where you are. Like if you look at many important metrics like the Shiller price to earnings ratio or the market cap to GDP ratio, we're near historic highs in many of those ratios. And so that doesn't tell you that the market's going to go down, but it does tell you that forward-looking returns can be questionable if you don't know what you're doing. So be invested, but be careful. So it's kind of like a contradictory message, very nuanced, but very true at the same time.
Yeah, that is, I like that. That is a good, that's good wisdom from someone who's got a lot of experience. You've been doing this for, like you said, more than 2 decades. And I think that's good for everyone to remember, especially our listeners, right? Everyone. Be careful. The market, like you said, is certainly not undervalued today. So you always want to proceed with caution and have that margin of safety. Jose, you and I, we could talk about this for hours. I think we can keep going. But we'll close it off here. It's a great conversation speaking with you. Where can our audience get in touch with you? Do you have a website? Where can they get a hold of your book? Give us that information.
No, absolutely. Yes, I do have a website. It's josemayora.com, and you can contact me through there for sure. And then in terms of the book, You can find it on Amazon. I have both the print and the Kindle version, and you can find it pretty much anywhere in the world. And so that's where you can go to get it. And yeah, that's pretty much it. Obviously, LinkedIn and maybe and social media, but I'm not a big fan of social media. So LinkedIn is probably the other good place to get to know me a little bit more. But yeah, that's pretty much it.
Okay, that sounds good. We'll put those links below in the description of this video for our audience. And Jose, once again, thank you so much for taking your time today out of your busy schedule to talk to our audience and share your knowledge and wisdom with us.
Likewise, it was a pleasure speaking to you. Very fun conversation, and thank you for having me.